Good evening, everyone. Today is February 27. I'm a bit later than usual, but that's fine. The content may be shorter tonight, but it's extremely important. It could influence how we assess the market over the next several months, even the next year. Today, the three major U.S. indexes sold off sharply. That immediately reminded me of an article that's been circulating online over the past few days. I read the entire piece. As someone who has long been deeply interested in science fiction, my team and I have been thinking about and researching AI-related developments for many years. The article was exceptionally well written. Interestingly, although it was published on February 22, 2026, it was framed as if written from the perspective of 2028, essentially a speculative look at the future. But what made it compelling is that it didn't read like fantasy. It simulated in detail how the economic system could evolve over the next 2 to 3 years. Why start with this tonight? Because parts of it are unfolding almost like a forecast. In recent days, software stocks have declined, particularly around concerns over profit margins, and the pattern closely resembles what was described in that article. One point in the piece stood out to me at the time as particularly unsettling. It mentioned that American Express could face one of the earliest and most direct impacts. The reasoning was that consumer credit conditions might begin to deteriorate. Today, a consumer lending company in France declared bankruptcy. That development closely mirrors the scenario outlined in the article. It specifically highlighted that American Express, as a leader in the consumer credit space, could be among the first to feel the pressure. And today, following the bankruptcy announcement from that European consumer finance firm, we saw heightened volatility across the three major U.S. indexes, particularly in the S&P 500. That connection is difficult to ignore. Let me connect this with a technical analysis we discussed yesterday. Yesterday, we pointed out that a potential double top had formed. That structure creates the possibility of a market top. The key question was how to confirm it. As explained before, we divided this range into three zones: weak, neutral, and strong. Over the past few sessions, I repeatedly emphasized that the battle within this range was critical. On the intraday chart yesterday, we identified a very unfavorable pattern: a gap up open followed by a gap down open, forming a failed breakout structure. Today, we saw another gap lower, and price action remained very weak. What does that imply? It suggests the fight within the neutral zone may have ended sooner than expected. The market could now rotate back into the weak zone and begin consolidating there again. And if we re-enter that weak zone this time, the recovery may not be as quick as before, because there are fewer bullish fundamental catalysts left to rely on. Let's review several factors that could signal a broader market top. Previously, we adjusted our market alert level multiple times, moving it up, then lowering it, and yesterday returning it to level 3. Today, I believe the alert level may need to move directly to level 5, a top warning level. Why? First, NVIDIA. NVIDIA saw significant weakness today. This is despite delivering earnings that exceeded expectations, strong Q4 results, and robust 2026 guidance. In other words, the company presented what should have been its strongest price catalyst for the year, and the market did not respond positively. That is notable. It raises the question of whether the AI infrastructure trade is facing exhaustion. At the very least, sentiment risk is increasing. Second, US PPI data. The producer price index reflects inflation at the wholesale level. If PPI trends higher, inflation concerns intensify. Rising inflation raises the probability of tighter monetary policy. From a macro perspective, that is not supportive for equities. Third, and most important, is the broader systemic impact of AI on the economic structure itself. This is something unprecedented in modern history. If you read the article I referenced in full, it describes how AI-driven productivity could radically reshape the economy over the next few years. Many public figures, including Elon Musk, have suggested that advanced AI and robotics could create an era of material abundance where people no longer need to work. That is an optimistic scenario. However, the transition phase may be far more disruptive than commonly assumed. The article gave a striking example: an employee at Salesforce earning $180,000 per year with strong benefits and a 401k. Over time, that role is displaced. The individual turns to gig work, such as driving, only to face displacement again from autonomous systems. Income declines sharply. If income declines across large segments of the population, while corporate margins remain high due to automation, consumption weakens. Wealth concentration increases, and consumption, particularly discretionary spending, contracts. Modern economic systems rely heavily on consumption and consumer credit. The three traditional pillars of growth are consumption, investment, and exports. If consumer demand structurally weakens, credit systems are pressured. Luxury spending, for example, is driven by human demand, not by machines. AI does not consume goods. If AI-driven productivity expands but consumer participation shrinks, the entire consumer credit framework could face long-term stress. And unlike cyclical downturns, technological displacement does not have a pause button. It cannot simply be reversed. So where will the economic shock hit first? It will hit consumer-related stocks across the board, as we just discussed. First, the AI infrastructure bubble could burst. Second, U.S. monetary policy could shift in a more hawkish direction. Third, the systemic impact of AI on the traditional economic structure, and that is something truly profound and potentially disruptive. Overall, from my perspective right now, I am leaning bearish. But does that mean I'm bearish on everything? Not exactly. Why? Because there are still certain types of work that AI will not be able to replace for a very long time, especially jobs that involve manipulating the physical world at the atomic or material level. For example, chefs. It's extremely difficult to replace a skilled chef. Even today, pre-made or automated food simply doesn't replicate the taste and nuance created by a high-end chef cooking fresh meals. That level of craftsmanship is not easily automated. Similarly, highly delicate physical tasks, such as precision surgical procedures, may remain resilient in the near term. And of course, industries tied to basic human needs, food, clothing, physical activity, essential goods required to sustain life, may experience relatively less disruption. This could partly explain why traditional industrial sectors, such as those represented by the Dow Jones, appear to be holding up better compared to high-growth AI-related segments. However, as we mentioned earlier, AI's impact on the economic system is broad, structural, and highly unpredictable. At this stage, we can only try to organize our thinking logically and prepare for different scenarios. So in the short term, I remain strongly bearish. Another very important point today is this: the main theme of our current economic system, and therefore our investment strategy, should gradually shift toward a more defensive posture. We need to lean defensive. However, while turning defensive, we must also recognize that AI development has not yet reached the ultra-advanced stage many people imagine. There are still opportunities in certain AI-related application technology companies. That said, personally, I prefer defensive stocks at this stage. For example, a company we previously mentioned, Vertiv. It operates within AI infrastructure. Before AI evolves into AGI, and even before any form of superintelligence emerges, infrastructure remains absolutely critical. The profit potential in this space is still very large. Why do we say its upside imagination could even exceed some chip companies? Because today, major tech firms are not buying chips from just one supplier. For instance, Meta has reportedly purchased TPUs from Google, and they've also bought GPUs from AMD. There are multiple chip options available. But when it comes to liquid cooling and specialized data center infrastructure, the number of viable providers is much smaller. That's where companies like Vertiv still have structural opportunity. Another name we previously discussed is Circle. Intraday performance today was actually quite strong. Although there was some pullback, it nearly recovered the earlier small red candle by the close, which keeps it in a relatively strong technical position. As I mentioned before, Circle represents the economic layer of AI agents. Once AI agents begin conducting transactions on behalf of humans, they will likely prefer blockchain-based systems and stablecoins, particularly on low-cost networks such as Ethereum Layer 2. Transaction fees are extremely low, confirmations are fast, and security is strong. Think about it. If you were an AI system, you would naturally trust code. You wouldn't necessarily trust an intermediary like American Express. A decentralized protocol governed by code may be more aligned with how AI operates. That's why the long-term potential of stablecoins remains significant. And Circle, in my view, is still a stock worth keeping on the watch list. Today I want to introduce another company, a very unique one. It's an egg producer called Cal-Maine Foods. Many of you probably know it. It's the largest egg producer and distributor in the United States. Why are we bringing this up? Because under rising inflation expectations, capital tends to rotate into food and essential consumer staples, especially basic necessities like eggs and pork. These are products people need regardless of economic cycles. Cal-Maine's recent earnings have looked solid, and its valuation is not particularly high from a PE perspective. It's worth paying attention to and potentially including in a defensive allocation. As I mentioned earlier, when inflation expectations are building and market risk levels are elevated, aggressively positioning in high beta assets can become dangerous. Right now, the overall index environment looks fragile. The alert level, in my view, is high. That's precisely why defensive positioning matters. We've discussed other names before, and I won't go into detail today due to time. But I do want to emphasize one final point. The coming period, possibly March or April, could represent a turning point in economic history unlike anything we've seen before. Will all assets continue rising into another capital frenzy, or will AI fundamentally disrupt and reshape the traditional economic system? We don't know yet, but from what we can observe now, the situation is not particularly optimistic. So the priority is to protect our assets and, if possible, use this period to steadily accumulate foundational capital. Thank you for following the channel. We share market insights daily. See you next week.